So last week we covered a lot of issues about looking at your PAYG, looking at what's being declared as income. So for those that missed the first week, feel free to go back to our recording. What I want to talk about today is looking at allowances, fringe benefits tax, and some compliance around that. So for those that haven't met me, and I think I've met half the people who are on today and half I haven't. So my background, chartered accountant, tax agent, financial advisor and broker, and been working started up Smart just over 17 years ago. And obviously we focus on finding accounting services and all of those, anything that the clients have a problem with. And that's why we've come up with today. A lot of issues going on. I mean, it's a tough gig actually being an employer and not only running a business, but then being an employer and everything else comes about. So what I've tried to do with this employer series is look at any issues that our clients have been asking us questions on and try and bring it into one central spot. And we have created an employer web page with lots of links in there, trying to bring it all into one spot as well. So today what I'm going to go through, and we've got two more other parts of the series as well. I'm going to go through allowances. I want to talk about allowances and kind of reimbursements, fringe benefits tax, and then also how can you reward the team to kind of achieve a win-win outcome for your team. So a win for yourself, win for the team member, and potentially at the expense of the tax man, I guess you could say. So how can we actually go about doing that? So some of the looking at allowances, and this is something we often get a lot of questions on, and it is often misunderstood. And unfortunately, we often get a lot of corrections that we have to make at a later point in time. So that's one of the reasons I thought it was worth covering these aspects. So what are allowances? What are reimbursements? Allowances are basically separately identified payments that are made to an employee. It could be, different working conditions. So some of the trades in the awards and things like that might have different allowances that are there. Could be an allowance to go get a certificate, first aid certificate or something. Expenses that maybe cannot be claimed as a tax deduction could be travel and work-related expenses as well. But an allowance is something that it doesn't like automatically give the person a tax deduction for it. So an allowance is something that you may have done. There may be requirements under your awards that you've done, but it's an allowance is then income to that employee to be spent on whatever that relevant aspect is. Where that is different is when it comes to a reimbursement, where this will be paid to your employee or contractor for actual expenses incurred. Now, the employer may be subject to fringe benefits tax or not. I'll touch on that. But if they are covered by fringe benefits tax, then the amount that then is paid to the employee is not assessable income to the employee. Employee can't claim a deduction against it. Whereas if it's a reimbursement, it depends on the situation, but it could be that there are actually assessable on it. But it is generally the reimbursement, the employee's incurred it, they give the receipt to the employer, and then that's reimbursed. Whereas the allowance might be a motor vehicle allowance. They get actually an allowance in there. If I use like a real estate agent, they could get a motor vehicle allowance, and then they will claim a deduction in relation to the motor vehicle. But just because they get an allowance doesn't mean that they automatically get to claim a tax deduction for it as well. So when does this allowance require PAYG withholding to be actually made? Now, I talked in last week, I spoke a bit about PAYG withholding, so you can go back to that session. But it's really important to have a look at this in relation to the particular allowance you're doing, because and a lot of you are using Xero. In Xero, you can actually set up these allowances in it so that it's all somewhat automated once you've set it up and you've got it right to start off with. So reimbursements, generally speaking, no PAYG withholding because it's a reimbursement. They incurred the expense. But for an allowance, there potentially may be a requirement to have PAYG withheld on it. So if it's the ordinary duties of the employment, potentially it would be. If it's related to business kilometres, 5,000 or less, generally, we don't have a PAYG withholding requirement on it because the expectation is that the employee is going to be claiming those kilometres, and there's not an automatic right to be able to do that. and therefore that might neutralise it, and we don't need the PAYG withholding on that side. An overtime meal allowance up to the reasonable amount, there isn't a PAYG withholding requirement. Over the reasonable amount, there is. So there is quite a list of the different situations that it might actually come up, and we can put a link to that, but it's worth getting that right and adding them as automatic different pay items in your Xero with the different boxes ticked of whether the PAYG is required or not. That way you've got consistency and you don't have to think about it every single time as well. And then when do these allowances require superannuation guarantee to be on it? If it's actually part of their ordinary times earning, then you would actually expect that they would have superannuation on it. Superannuation does not apply, though, to expense allowances or reimbursements. So again, when you're actually setting it up in Xero, you can actually tick the relevant boxes. If you've got questions on these, let us know. We can look at and refer you to that list of them, because then you've got some of them that are reportable on the employee's income statement, or as I always like to say, the payment summary. Some of them are reportable, some of them are not reportable. So as I talked before about the award overtime meal allowance up to the reasonable amount, not reportable, no PAYG, no super on it, whereas some of them will have it actually required on it as well. So it's really important if you can get those into your Xero file and get those then right, then going forward as you have those. And so often we find when a client might have this, they might have a project that now the project's interstate and all of a sudden they've got a few of their team and now going to be travelling interstate. If you've got those situations, we can work through those. Have a look at your awards if your employees are under a particular award, just to make sure whether they're going to be covered. Another one that's been coming up quite a bit at the moment, and this has been a focus of the ATO, has been travel allowances versus living away from home allowance. And the reason for that is the ATO did change the rules on living away from home. So, you know, they changed the rules and now it's a focus point, so to speak. So when we look at travel allowances versus living away from home, it depends on how long the employee is going, why they're doing it, how long they're going for. So are they traveling away? They're going to Sydney for a few nights for a training course or for a client situation. That's going to be a traveling situation. Or are they relocating? They've got a project down in Tasmania and you've got them moving down there for 6 months. Are they repeated trips? So it's really important to look at the characteristics on it. There's a few decision trees with the tax officer's new requirements on the living away from home allowance. So a travel allowance is an allowance that the employer is paying or is going to pay to an employee to cover what we would, I guess, call losses or outgoings that the employees incurred because they've travelled away from their ordinary residence, you know, whether it's inside Australia or outside, so that they can do their job as an employee and do that. So they've incurred for accommodation or for food or drink expenses and that have been incidental to the travel. It will be assessable income to the employee because it's a travel allowance. It will be assessable income, and then it doesn't guarantee that the employee automatically gets a deduction. So they can't just claim a deduction that matches the travel allowance. They need to have receipts and go through all of that substantiation as well. And that will be on the employee side, that when they're doing their individual tax return, but it is an allowance that you've actually then provided. This is where that's different, as I talked about earlier, of a reimbursement. They incur all the costs, or you might even give them some money in advance, but it's a reimbursement that they're actually getting reimbursed for the costs incurred as well. Where is that kind of different from a living away from home? That's where it's actually a change in the employee's regular place of employment, and it comes down to the length of the overall period that the employee will be away from their usual residence. Usually it's a long one. So if they've got a project, say in Tasmania, and they're going down for 6 months, now they may still come back, obviously, to visit the family, but, you know, you've organised accommodation there and you've gone through that. And so the living away from home, they've literally kind of, I guess you could say the ATO has kind of literally rewritten all of these rules, and they've been a lot more specific on what you can and cannot claim on it. Now, on the living away from home allowance, and I've had so many clients now that are actually kind of falling into these rules with the different projects. So an allowance will be a living away from home allowance, and there's more incentives that are then provided. And that will come if you get a living away from home allowance. It's a fringe benefit, but it is what we call non-assessable, non-exempt income in the hands of the employees. The employer potential exemption from fringe benefits tax, which I'll touch on in a second, and the employee doesn't claim a deduction for the meals and accommodation and expenses they have when they're living away from home. So it's really important when you've got that situation to try and work out, is it a travel allowance or is it actually in fact a living away from home allowance because of the different definitions. There is a safe harbour that the ATO's put out there. I've just put the reference to it, but what they're kind of saying is that if the employee is at the same work location for not more than 21 calendar days continuously, or at the same location for not more than 90 days during a whole fringe benefits tax year, so a 12-month period, then most likely it's a travel allowance, not a living away from home allowance. In some situations, clients would like it to be a living away from home allowance where possible, so you need to look at the facts and circumstances on that. Now, when we talked about what is the reasonable travel and overtime, each year the ATO puts out an allowance amount, and they update this each year to say, what does that mean if you've got someone going to, and it goes on their wage bracket. So that, you know, I've done a screenshot here of the wage bracket up to 138,000. If you send someone to Sydney, they expect that if someone's on that wage, they're probably not paying more than $198 for their accommodation. I think these figures are pretty low, to be honest, when I look at the accommodation. Then you've got your allowances for, say, breakfast of 32, lunch of 36, and dinner of 61.50. So incidentals to give a daily total as that. So if you've got that, you don't have to use these reasonable amounts, but this is the type of amounts that we've got on there that the Commissioner's got out there as well. So the important thing about when it comes to these types of allowances is that substantiation is required unless there's an exemption. So just because they got the allowance doesn't mean that they don't have to have it substantiated. So receipt of travel allowance, not an automatic deduction, and I find that's a challenge that we often have to do it. The same substantiation applies with work-related expenses. So written evidence is required on it. And it's only when it's within those reasonable travel or overtime meal allowance period that you can kind of not have to have all of that substantiation. But I always say to employees, keep all of the receipts, because if some things go over, you're going to need to have that receipt. And I guess if they're getting allowance, again, it's most likely a reimbursement, but depending on the situation as well. And the employee must have incurred the expenses for it to be deductible and being able to claim that as well. So the key things when we're looking at allowances, isn't an allowance that you're giving them a fixed amount and they can then do what they want to do with it, and then it becomes the employee's situation on their tax return? Or are you actually reimbursing them for an expense that they've incurred? So then that kind of negates any tax situation on that side, but you'll need the receipt on it. And then is it a travel allowance or living away from home allowance that you provided? And you also need to look at the different awards, because there are some of the awards, especially under the trades, where the living away from home allowance, under a normal situation, there may have been one tax treatment, and under that particular award, there are different tax treatments based on what was negotiated in the award. So always go back to the award that the employee is under, just to check on that side of things as well. So fringe benefits tax. So just to give you a little bit of a background on fringe benefits tax, and so fringe benefits tax hasn't been around forever. I know when I first started at Ernst & Young, we used to all go for lunch every Friday, and that was I guess you could say with some of the pre-FBT, when they didn't have to pay tax on it all. And then all of a sudden, once they brought in this, those lunches on a Friday definitely reduced. But fringe benefits tax hasn't always been around. It's an interesting tax from a tax authority perspective, because they actually don't make any money on it. The fringe benefits tax that they collect is about how much it costs to administer the system. So then you say to yourself, well, why don't they just get rid of fringe benefits tax if they're not making any money on it. Basically, their expectations are that if they got rid of it, people would spend way too much money on a lot of these personal expenses. So just as a recap on fringe benefits tax and what does it mean when we're talking about the benefit. So the value of the benefit is, instead of paying an employee an extra, say, $5,000, you've provided them, whether it be a car or you've provided them with other benefits that they haven't yet had tax taken out of because it hasn't gone onto their normal payment summary. So when we're looking at a fringe benefit, you look at what is that benefit provided to the employee? Was there any contribution made by the employee? Was it otherwise deductible? And I'll talk a bit about those rules, but was there, was it that they could have deducted it themselves? Any particular exemptions that might be available to come up with what we call the taxable value. That's the amount that is going to then be taxable as the employer filling out your fringe benefits tax. There's a gross up amount. The gross up amount at the moment is 1.88. So we take the taxable value, gross it up by the 1.88. That's our grossed up taxable value. And then we pay tax at 47 cents in the dollar on that grossed up value. So that's just a bit of background on FBT. So what is it that we're looking for? So what attracts the attention of the ATO? At the moment, the ATO is really focused on fringe benefits tax. There's been a number, probably for the last 3 years, really focused on fringe benefits tax audits. Clearly, they're getting a lot of return on investment because they keep doing it and they keep allocating more funds to do the audit. So they're really focusing on employer-provided vehicles. They got about probably 3-4 years ago, they got access to the Vic Roads information. As soon as there's cars within a company and you're not lodging a fringe benefits tax return, they want to know why. Have you accounted for it properly? And what's the situation on that? So car fringe benefits exemptions, people think, oh, I've got a ute, so clearly it's exempt. No, there's only particular cars that are exempt from fringe benefits tax, certain models, and that has got tighter and tighter and tighter. So no, it's not just an automatic. So the ATO are getting those Vic Roads records and trying to match those. There's been a lot of incorrect way of treatment of employee contributions and how that's been done. And then also there's a lot of entertainment that goes on that hasn't been put through fringe benefits tax returns. Now, with entertainment, there's a few ways you can do that. And so you can actually just do it as an overall add back in the tax return. We usually work out that that's actually the most cost effective for our clients, rather than actually having your fringe benefits tax payable on the entertainment part as well. Car parking fringe benefits, not too many of my clients have that situation where a car park's being provided to the employee that is within a range of a public paid car park. You've got car parking on site and there's lots of car parking in the street, then you're not really got a fringe benefit on that. And then I say non-lodgement of fringe benefits tax returns. So we highly recommend to our clients, even if the fringe benefit taxable amount comes down to nil because they've done add backs, we strongly recommend you lodge a nil return. Why do we say that? Is once you've lodged a nil tax return, then your period as to how far the tax office could go back and amend gets locked in. They've got 4 years, can't do more than that. If you don't have a fringe benefits tax return, there is no amendment period. They can go back from company inception as long as they want to and amend all of that. So that's why we say to clients, it's worth lodging that return because it fixes that period in place. Just the same as your income tax return. But if you don't have that return lodged, open slowly, they can go back as far as they want to. So looking at the travel and transport that I was talking about earlier, there are 2 new rulings and so what the ATO does is they come up with new rules and then they go, oh, and now we're going to apply these new rules and we're going to come and audit you and make sure you're doing that. So they have put these 2 new rulings out there. One is when an employee talks about when an employee can deduct transport expenses. With those rulings, they have a lot of detailed examples, and we can often find the client situation in a lot of those examples. Then they've got another one talking about the deductibility of an employee with accommodation, food expenses, travelling for work, but then also the living away from home allowance versus travelling for work. So if you had a question about your situation, we'll be going to this ruling and trying to work out those and go through those examples as well. So when an employer pays for the transport, there may be fringe benefits tax if it's related to regular place of work. So, you know, they're turning up to work and you've paid for, you've given them a bus passes, or you've paid for it. Even if the employee lives a significant distance away, if you offer to pay for that, that is a fringe benefit that you're providing to your employee. Exceptions can be they've got bulky equipment that has to be carried, and that's why you've got that situation. And then there can be some particular eligible vehicles, and I'll talk a bit more about those. Fly in, fly out workers, again, this is one, and this is why this whole living away from home allowance, it used to be a bit of a free-for-all, and you've got, a heap of people flying across to Perth all the time, and all these allowances are being paid. But they've now actually changed it to being, there is fringe benefits on that between home and the transit point, and they've spelt out the details on that. So if this is relevant to you, then let us know and we can walk you through those, because there is a taxing point, whereas a lot of fly-in, fly-out workers thought everything, if they got the travel paid for, it's all completely tax-free, so to speak. There are some, which is interesting, under their awards that actually, the rest of the population has to pay tax on, but under their particular award, they don't. And that was a special exception on it as well. But it's really important to make sure you've got a lot of the documentation around that. What about when the employer pays for meals, accommodation, and some of the incidentals? There's no fringe benefit when the employer's away overnight for work, unless the expenses it has been incurred because of their personal circumstances. So especially with, I guess we saw it with COVID and people moved interstate, and now they still want to work remotely. And I've got some clients where they've got someone working from Queensland, and they've been reimbursing them on costs when they travel down here to, catch up with the team. But that actually is not a situation where that's a personal circumstance, but they chose to live in that particular location. So as you can see with the dates of these particular rulings, the ATO post kind of, you could say your COVID, they've quickly gone in and changed on that situation as well. So if I look at that overnight travel, and this is why when people are looking at it going, is it living away from home allowance or is it traveling for work? Expenses are paid by the employee. Traveling for work, deductible, allowances accessible, one would assume hopefully they net off. If it's living away from home allowance, expenses paid by the employee, not accessible to them, but not deductible. If it's paid by the employer, fringe benefits tax. Is there any fringe benefits tax? Traveling for work, no, there's not. We don't need to worry about it. But on the living away from home aspects, there potentially is, but there are concessions available. So it may mean that once we apply the concessions, there is no issue. But given that new kind of focus on the transit point, there may be some as well. But the next one, when we talk about fringe benefits tax, my absolute favourite is the new with the electric cars. I mean, I was always a big fan of the looking at it from a car perspective and why do we have so many of these smart cars zipping around. But what you'll start to see now is you'll see all of our smart cars are actually being converted into electric. They're being replaced and getting the electric. Now, there was an FBT exemption for electric cars, and it really was a push to increase the uptake for electric cars that are going on. And, really, it was not just at straight electric, also at the hybrid, but to aim at low and no emission type vehicles. So you can see here in the picture, Cam and Anne with their BYDs. So the BYDs are the electric cars, fantastic cars. But looking at those, so what is this exemption and why might it be beneficial from an employee perspective as well? So basically your electric vehicles, you've got also your plug-in hybrid electric vehicles. Now that is only until March next year. Your general EVs are till June next year. So they brought in the rule and they said, we're going to test it out for 3 years and we'll see if it makes a difference. And the difference that it makes, and I think I would hope that they're going to extend it, but we're not going to know about that until the budget pretty much next year, the federal budget next year, whether they extend it. If they don't extend it, you could imagine they do the budget, there's going to be a mad scramble to get those electric vehicles before June 30 next year, or the hybrids. Now, with the hybrids, make sure you actually check the specific hybrid vehicle, because not all hybrids are eligible for the fringe benefits tax exemption, and it's only till 31st of March as well. Now, they have to be below the luxury car tax threshold, so they have to be below the 89,332. So I know when that first came in, Tesla reduced the price of theirs just to get below that as well. And it has to be the first retail sale or any subsequent sale on that, and held and ready for use after 1st of July 2022. So really good opportunity. I've got some numbers to crunch through on that as well. It does also apply to the car registration, insurance, repairs and electricity. It does not apply to the cost of a home charging station that you might put at home as well. So with the EV, and then I guess some of the limitations on it, but just so that people are aware. So there's no fringe benefits tax now, and I'll show you when I do these calcs and you'll see the numbers. There's no fringe benefits tax on electric vehicles, but you do still need to put it into the reportable fringe benefits tax amount. So you calculate what is the value to the employee, and instead of them paying that 47, grossing it up, so you do gross it up, and then you pay 47% tax. You just don't have the tax, but you still need to record the reportable fringe benefit, and that will be applicable for your employees. It might be child support, it might be other aspects that the government uses the reportable fringe benefits tax amount. It doesn't apply to sole traders or partners. So it needs to be then the employee gets fringe benefits tax. And so you need to make sure, even if the person is a shareholder of the business, because it's their business, that you put a notional wage at least through to show that they're an employee of the business to be able to get it. So what about, and these are some of the questions that I've received, and when you see the numbers, you'll see why all of a sudden it's very interesting for people to do it. So what if the employer directly reimburses the employee for the purchase of their electric car? Unfortunately, no. You cannot get the FBT extension, because when these rules come in, there were a lot of employees that were approaching their employers saying, hey, I've had that previously, can you reimburse me? No, that doesn't apply. If the parties enter into a salary sacrifice arrangement, yes, it can actually apply under that. It can apply under a novated lease situation, which is basically the finance company, employee and employer. And the other big question we get is part of the value of the electric car, what if it's higher than the luxury car tax limit? Now, when you have your depreciation, and we have our motor vehicles, and you come up to around the 60 that you can claim the depreciation, you get that, and you've got that. Yes, you can claim pro rata, you just can't do the bit over. Unfortunately, with the EV, as it relates to the fringe benefits tax, etc., you cannot claim part of it. So you're either fully under and you get the exemption. The minute you're $1 over, you don't get it. So that's really important when you're looking at what is the car that you're looking at buying. For some reason, a lot of people thought that you had an electric vehicle meant e-bikes and e-scooters. Unfortunately not. So the exemption only applies to cars. Motorcycles and scooters are not cars, and so they're just coming under your normal fringe benefit aspect. It is a shame, because that could be a bit of a potential for people, but a lot of people thought it was vehicle and thought it did cover it. So, depending on the situation, you might have other aspects on it, but as far as these EV rules apply, no, unfortunately, they don't come under that as well. So when we talk about employee contributions towards the fringe benefit, what are we actually looking at there? That might be a situation where, and often if it's the business owner, we might record that as a journal, because we work out what is the taxable value, and then we might record to the director's loan that taxable value to bring your your gross taxable fringe benefit amount to nil, so that we can lodge a tax return that says, your FBT tax return that says you owe no FBT. So, but there may be situations where the employee is making a contribution back. So the employee is making a contribution maybe through their wage, maybe it's $500 a month. Sometimes with the salary sacrifice, there will be those amounts that are coming through. It is a focus of the ATO because they want to make sure that what is being contributed back is actually correct, because sometimes we've seen it where they've got the amount coming back, they've had GST taken out or not taken out as well, and it needs to be recorded, I guess, if it's by a journal at the time when it actually was incurred or by the time of the FBT tax return, but you can't really do it by journal for an employee that's not yourself as part of your kind of business owner situation. What happens with it is we do have income tax aspects on it. You've got the cash or offset income of the employer, but if there's no employee contributions to the third party, I mean, the only other, either A, it's fully subject to fringe benefits tax, or the employer is opting to take that out of their personal pocket director's loan, which is not a smart idea. We have some clients that say, oh, just do that like that. Not a good tax outcome for you. You want to put that through. There can be GST aspects on it as well, just in relation to fuel. The GST inclusive contribution reduces the taxable value of the fringe benefit, and it is considered what we call a taxable supply. So if you've got questions on some of these, it's worth kind of raising them all with us and we can go through, because the rules are quite complicated. Even if you put that, when you're processing it through their payroll, get us to have a look and we can then make sure that that's being flagged through the right way to kind of get it. They are trying to do a kind of they say a simplification of the FBT record keeping. It is a complicated rule on it, and these new simplifications are applying for this current, so a fringe benefits tax year. They decided to make it easy on accountants when they brought out fringe benefits tax, and they said, look, let's not do it at 30th of June because, accountants got enough to do around 30th of June. Let's give them a favour. We'll do it from 1st of April right through to 31st of March. It's actually, we've been calling for them for years to align the tax year because it makes it really harder for us in that. Now, what are some of the simplifications on it? They want, if basically, with the living away from home allowance, they've simplified in being able to do the estimate of what those amounts would be based on the different locations that you might go to. But otherwise, I suggest for most people making sure that you've actually got the receipts and the deduction, the receipts for everything, and then we can go through on it as well. But they're trying to simplify what would be the requirements. A lot of you would know at year end, we get you to sign a lot of documents with your employees as well. I always look at travel diaries are always a good one to make sure as well with employees, so that you can actually document, if they've gone to a trip overseas, what did they do when they went there? They went to a conference, or they went to the particular client location. How long were they gone? What was that situation? So they are trying to, and some of this is still in progress, but they are trying to simplify some of those. So going off the fringe benefits side, how can you reward staff? Like, what are some of the perks that you can do? And some of this does align in with the fringe benefits, but what are some of those perks that you can look at doing? So salary sacrifice arrangements, what's really important when you're looking at a salary sacrifice arrangement is making sure that you actually have the documentation in place, and we can help you with this with the written agreement. Is there an employee contribution? If there is no employee contribution, now maybe you have an agreement with your employee that their contribution brings it up, so there's no fringe benefit, which they may like as well, because the fringe benefit kind of comes out of their total package. It's not like you're paying them extra and then you're having extra tax on top of that. But there is definitely benefit on the salary sacrifice arrangements. Why do all the large companies do it and small business don't? And and the main reason is it's an unknown for a lot of small businesses. You've got to put the documentation in place. Why do we have lots of smart cars? Because I guess I can do the documentation. I know about all of those rules, and I guess that's where we can help you on that side of it as well, to kind of cost it out on that side. You've also got the novated lease. What's a novated lease and where's that difference? That's where the employee enters into the lease with the leasing company, and you literally have a three-way situation. You've got your employer, you've got your employee, and you've got the novated lease company. So the employee has the car in their name. They have the novated lease, which basically is saying that the employer is taking on those lease payments until a future event occurs, i.e. they sell the car or the employee leaves employment, and then they take that over as well. Employee can't deduct the car expenses. There are some potential exemptions for the expenses under the car fringe benefit. And because the employee tends to pay the residual amount and acquires the car at the end, the way in which it's often structured with the novated lease is that there is an amount that is then withheld from the employee to bring the FBT down to a certain amount as well. What we often do when I look at it at Smart, rather than doing the novated lease situation, so why do I do that slightly different? I actually have it that Smart owns the car. There's a few reasons for doing that as well. One of them I like on it from the employee's perspective, and I guess you could say employers, but more on the employees, is that you've got that liability for the car. That's not something that falls under the employee's name. When they go to get home loans and all of the above, they get the perk of actually having the car benefit and availability of the car and all of those factors when it comes to a lending situation, but they don't have the liability. So it's a really, if as an employer you have the ability to do that, that's where it can be a really good perk on that side as well. So when we're looking at structuring the car benefits, we look at calculating, and this is where some of this benefit comes. You calculate it on the GST inclusive and exclusive of the car expenses, because the business, and under the novated lease it's the same, gets to claim the GST. What your employee's technically getting is they're getting the expenses without the GST aspect on it. We need to calculate what the fringe benefits tax amount is on it, because that is going to be a cost or part of the overall package. And then you're playing with it. What's the employee contribution to come to an overall amount? And this is where, when I look at it, the EV comes in and the dollars that can be a benefit from that perspective. So I'm going to use the new seals that we've got as an example. I'd have to say, having a Tesla myself and seeing the seals, I can tell you there's a lot of value in those seals. And all the niggly, annoying things about my Tesla, I guess the Chinese do this well. Basically, what they've done is they've gone, those are the really annoying things about the Tesla, and we're going to make those the prime things that we're going to fix in the BYD, or we're going to put in the BYD, which is fixing the Tesla's problem. So the niggling things about my Tesla, the BYD does not have that issue. But it's a lot of car for what you're paying. So the total cost of the car, $47,876 for the BYD Seal, which is the sedan. That's the new one. If I look at my employees, they've got pretty much minimal business usage. We're not on the road that much for our work. I've actually done it as an employer, so purchased it. So it means from an employee's perspective, you've got Cam Madly savings for his first home, not going to show up as a liability on his name, any of the above. It's going to be subject to fringe benefits tax, but the EV is exempt. So technically this means, so normally when we don't have an EV, we can apply either the business usage, let's face it, there's not much business usage for the team, so it's going to be pretty low, or we can apply the statutory method, which is 20%. So that means that generally speaking, most people that get a salary sacrifice car, or whatever you want to call it, novated lease and all of the above, get a tax deduction for a car from pre-tax dollars of about 20%. Now, why is that good? Because generally speaking, 20% is better than 0%. The average person, say working in an office, is getting a 20% deduction for their car under statutory method through the FBT calcs and all of the above, versus a 0% that they'd get none. So that's great. When you've got an EV, we have converted that 100%, that 20% tax deduction into 100% tax deduction. So my team that have the EVs are now getting from their pre-tax wage or package, you could say, 100% tax deduction for their car, which is incredible. So that is the big perk. And I've had some clients that have salary sacrificing, and they've come to me and, oh, I'm just renewing my salary sacrifice, getting a new car. And I'm like, have you considered an EV, which they hadn't? And I said, go and get the novated lease company, because they work for one of these big corporates that you have to go through a certain company. I said, go get a quote for a similar car that's an EV, similar dollars, and bring me the two quotes. We're talking about personal cash flow for them, one of my clients, about $800 that they would have had to be paying personally for the fuel car versus if it was an EV. So guess what? They went with the EV. They had no idea about the EV. So they're getting 100% tax deduction. So I've just got some calcs here for you as to how does that all work. Now I'm going to go through petrol versus an EV. And this is why it actually becomes quite attractive. So cost of the car, you've got total cost, but you've got, rego and all of those things. So looking at what are your lease repayments on an annual basis, what's your insurance, rego, servicing, well, I don't know, because with the EVs, we probably don't have to pay much in the servicing, but, I put a figure in there, we're guesstimating. So what's the total cash that it's costing the business? So if I look at Smart to provide the Smart car, the total cash paid, $15,603. There's a tax deduction that comes with some of that. So it's $888. The tax effect on that. And then I look at actually, well, what is the net cost that it's costing to provide the car? So say $14,715. So if someone's package was, $80,000, I would be saying, okay, instead of paying you $80,000, I'm going to go 80,000, take 14,715, and there's the cash part of your package, and the rest is being provided in a car. And you'll notice here, because it's an EV, there's no fringe benefits tax on it. So what is the value after tax? After tax value, there is definitely clearly still a benefit there, the 14,715 versus the 15,603. So, that's good benefit. After tax value to the employee, there's still extra dollars on that side of thing. But here's the big one. What's the pre-tax value? What would that employee have to earn somewhere else from someone who does not offer being able to do this kind of package? They're going to have to get $28,609 of pre-tax dollars that they would have to be earning somewhere else. This is why all the big companies offer these company cars, and then the small business, we don't, not everyone knows about it, and then they don't do it. So it's $28,000 that they would have to earn somewhere else to get to the same situation. Now with the EV, they're getting a situation where their car is pretty much 100% tax deductible. Now the issue with the petrol is you have $6,200 of fringe benefits tax that you're donating to the tax man on that. So you still have the same after tax and the pre-tax in a sense on it, but the cost of the extra car to me is the $6,200. So what am I going to do? I'm going to be like, well, sorry, employee, but you have to take that out of your take-home cash that you're getting. So that what pretty much the EV exemption has done is it has taken what normally would have been a 20% tax deductible car. In a sense, the employee would have got 20% of their car as tax deductible kind of benefit to 100%, which is just incredible from that perspective. And it's interesting, we used to have, I guess, our cars, when I neutralised the two out, a $30,000 petrol car was the same value as a $50,000 EV because the difference in the fringe benefits. Not only that, now you've got the savings on fuel, which is just an extra benefit that they're getting, but they're basically getting 100% tax deduction for their car, that when you put it all as the package, that's never going to happen for someone who's working in an office all the time. So just recapping on some of that, exemptions till June 2025, except for the hybrids, which is only till March next year. And make sure you check that particular hybrid. If you're not too sure, let us know the exact model. Probably the dealer knows, but you just got to double check, because you don't want to buy it and then find actually, sorry, no go, and you don't get it. So obviously applies to the different electric cars. Car value must be below 89,332 as well. And obviously if you're buying it now, this part's not going to be a problem on it. So it only applies to vehicles that are provided to employees, not partners and not sole traders. So make sure that it's not provided to the partner, it's the employee. Doesn't stop the partner from driving it a bit, but it's being provided to the employee. So what I mean by that is, don't the EV exemption, what I've seen with some clients, they might still do it under the fringe benefit. They might have 2 cars that they've provided to an employee, and they've linked all of that with the spouse and that. You can't do that with the EV side of things as well. So make sure you've got that. Charging stations, they're not covered. Just on the electricity, the ATO has put out a special ruling on how you can claim the electricity that you've done from expenses and things like that as well. Now, just because you've got no fringe benefits tax, it does still go on to the reportable fringe benefits tax amount, which may impact child support and any of those other things as well. So it's worth having a look at if you have that type of situation. Basically what you're doing is you're converting what is a 20% tax deductible situation for an employee, 20% of their car usage is tax deductible to 100%, on that. Can also mean, I guess when I look at it from my side, I've got it in the company, kind of makes the employees a little stickier, because then if they leave, they have to buy another car. So, that's kind of a benefit on that side as well. But I see it as a win-win, because it doesn't impact their borrowing ability. We get to show what that value is to them as their total package. Your total package is X, which is made up of cash and the car. So there's benefits on those sides as well. Other things that you can do are work-related portable electronics. Now, I talked about earlier about this otherwise deductible rule, which I'll touch on a bit more. But basically, there's exemptions that are there for electronic devices like mobile phones and things like that. So there can be situations, and I have a number of my team, maybe because when you're an accountant, they're onto these rules. So there's not a pay period that goes by that someone hasn't bought something and said, can I salary sacrifice this? So we get our standard contract out. So if you need, it's a 1-pager. What that means is someone goes and buys a new phone. A new phone does come under this otherwise deductible. What it means is if they salary sacrifice it, the person may have bought it from JB Hi-Fi. They give me the receipt. I then have to do an adjustment through their payroll. We can help you with that. But what it basically means to the employee is they get the GST back. So that's a win for them. And they get it with pre-tax dollars. So I get them to sign the 1-pager agreement. I just need that to make sure I have no issues with the tax man later. I reimburse them for the full amount. They paid $1,000 inclusive of GST to JB Hi-Fi for their new iPhone. I, in theory, reimburse them for the $1,000, and then I salary sacrifice that through their payroll. When I salary sacrifice it, you salary sacrifice the amount without the GST, because I get to claim the GST as an employer, so I can do it without the GST. So you've already just given a benefit of 10% straight off the bat to your employee. And then that salary sacrifice, because it's otherwise deductible that's exempt, and if you've got otherwise deductible items, it's already expensed, that comes out of their pre-tax. So let's just say their tax rate is 30 cents in the dollar. By giving them, because you've allowed them to salary sacrifice, again, why do all the big companies do this? Because it's a really good benefit for their employees. Small business don't do it so much because they don't know how to do it, and maybe it's a hassle. So, but if you can do it for your employees, you've enabled them to buy a new phone. That means they got their GST back, 10%, that's, winning. And if their effective tax rate's 30 cents in the dollar, they're buying it from pre-tax dollars. So you've just literally saved them 40 cents in the dollar. on that particular. So they bought an iPhone for say $1,000, and I'm using round figures. They're getting $400 back. So they're going to love you as an employer if you enable them to be able to do that. So if you need help on how to do that, maybe I should do a separate video on how to do that in Xero. I'll add that to my to-do list. But that's something that can be a real win for employees, and only a little extra bit of work that you might have to do. So yeah, I can tell you, not a pay period goes by that I don't have someone buying, a new, laptop that they will do some stuff on, portable, whether it be a new phone or whatever it is, things like that, an iPad, all of those types of things. But anything that's otherwise deductible can be, and otherwise deductible means that if it wasn't being put through, in a sense, the books and things like that, that they could have claimed a deduction. If it's otherwise deductible, then we can put it through, and they can do it through their pre-tax. If you work for a not-for-profit and there's specific rules on that, there are other things related to fringe benefits tax. You'd need to check on those particular things as well. The other big one I love is the on-site meals. So what we have here at Smart is I'm always about with obviously my clients, anything I can help you with to get rid of the pain points, that's what I'm trying to do. I also look for those pain points with the employees. So a few years back, because I saw the pain point was, oh God, what am I going to have for lunch for today? Didn't bring in lunch. Now I've got to go down the road and all of these types of things. So I introduced where I said, okay, here's a budget for the office. Fridays, we order a Woolworths order, gets delivered to the office on Mondays, and lunch is basically provided for everyone, lunch, breakfast, and all of the above in between. Now, if you're providing meals on your workplace, now obviously I can't provide them alcohol and things like that, because that wouldn't work well with client work in the afternoon, but also you can't kind of claim those ones. But all of that is tax deductible. Then you look at the other side, and the benefit is the fact that I've got all of the team from a cultural perspective. We've got the air fryer happening, we've got the oven, we've got all of those things, but everyone's eating lunch together. It's really added to the culture in it as well. But not only that, no one has to think about what they're going to bring for lunch, because we've already, last Friday, we've got a Teams chat, everyone, the grocery chat, people add things on and what they want. They've got their budget. How the team choose to spend that budget as a collective team is up to them. And then the delivery comes. But the value of that, and I look at it, I think cost per employee, absolutely minimal, all tax deductible to me on my side, but I've just taken pain points out for my team. So they get their meal provided, loving that. They don't have to think about lunch in the morning. And the net cost to me is actually not that bad at all. So I think the budget they get, the budget they've got is $250 a week. We've got a lot of team members. We can feed the whole team for that. And I've taken all their pain points away, and I've created this culture of them sitting around and eating lunch together. So it's a win-win. I was talking about it. There's a whole group of accountants, about 30 of us at this particular training. And I don't know how it came up, and I was telling them anyway, every single one of those accounting practices has now implemented this. They couldn't believe it. They were like, this is great. But I just look at it as bringing pain points away for something that doesn't actually cost as much and adds a lot more value. Another really good one to think about as well is, what about some training conferences? So would have been about, I think, 2 years ago, Anarika and Aaron, they went off to XeroCon in New Orleans. Now, what happened with that was a good training course, paid for their return airfare, paid for their accommodation while they're at the conference and the day either side. And then I guess you could imagine both of them went off and did some trips in New York and all of the things that they both did outside of that. And that was, on their own expense and all of the rest, but they'd gotten to America. So it really provided a benefit that had I just given them a trip, unwork related, would have been subject to fringe benefits tax and all of the above. It was a conference. It added to the, they learned things while they were there. It added to the value, networking, motivation. I can tell you they were pretty happy about going to that conference. And then they brought back value as well on that side. So when you're looking at some of these things, because I do have clients who say to me, oh, one of my employees, they've been working really hard. I want to send them and their family up to Queensland because they've just been doing a great job. And I'm like, well, unfortunately, you can do that subject to fringe benefits tax, or unless you put it into their own name and stuff. But if there is a conference that you can work around in that situation, so both of them bought, and Eric had a friend join her, Erin's husband joined, that was all on their own, costs and things like that. But if you have a conference that you want your team member to go to because it's going to add a lot of benefit to your business, see how you might be able to add these kind of perks on where you can get this win-win. So it's a really great win for yourselves as a business owner, but really good win for the employees as well. The other one is that a lot of people don't think about this one, and it's worth keeping in the back of your mind, is that there is what we call a minor benefit. So you can provide a benefit to your employee, must be less than $300, and in frequency, you can't do, $10 a week or whatever it is. But in a 12-month period, under $300, it can be a minor benefit and then not be subject to fringe benefits tax. So that's something that you can provide, that type of benefit to your employee, and not be then subject to the tax side of it as well. So the minor benefit is definitely something to think about on how you can kind of give. Must be infrequent and irregular, but maybe it's, you've gone on to this particular event or you've gone to a certain thing. So something, if you're not too sure, we often in Xero get people to put 2 different line items that might be entertainment subject to FBT or not subject to FBT. So just to make it easier when you're doing that. But do think about the minor benefit. If you do that with your employees, make sure you kind of indicate it in it so that we know that that's what you've, that it is under that. Is it per employee? So if you do provide those benefits, make sure you put, that it was for this particular employee so we can see if there's under 300 on that side of things. So that's kind of wrapped up everything that's come through on looking at allowances, looking at reimbursement, so getting those 2 right, living away from home allowance. So always worth going through that. It was actually, I guess the rules that they've put in place now, there's a lot more detail, but I also want to say there's a lot more clarity on it because it was very general. And obviously when the ATO would come in, it would be something that there would be issues on that side. Then you've got your fringe benefits tax. And really, I'd encourage you to think about the EVs, especially with that rule only until June next year. And we haven't had, and we're going to have an election too. So we're going to have a change of government and all of the above. We don't know if that's going to be extended. If it is extended, great, then, we'll have more time. If it's not extended, you're going to have a mad scramble and no one's going to be able to get those cars in that time. So it's worth thinking about, but you are able to convert. And it could be something that you look at some of your employees on. How can you get a normal salary sacrifice arrangement because of the 20% can get them, a few $1,000 benefit because they've got it. When they've got an EV, they're now 100% tax deductible on that side of things. Think about the shopping side of things. It's a small thing, but the benefit that you get on the other side, again, looking at phones, iPads, and all of that. So if you need help with any of those, let us know. But these are some of the things that as an employer that, it's a little bit of extra admin for you to do it. Once you've done it once, you'll be fine, you'll nail it, but can provide real benefit with your employees that will ultimately give you benefit as well. So I'm just looking, I've got questions. Does a phone, etc., have to be bought in the current tax year? It has to be bought in that kind of, I guess you could say that fringe. Well, we have the fringe benefits tax year, so it has to be bought in that, and so that you've salary sacrificed it through their payroll situation in that particular year. Can you get a fringe benefit as a business owner? You just have to make sure that you have a wage going through because you need to be an employee. It doesn't matter to be what that wage is, but as long as you're an employee and it's been post 2022, so you get that. So if someone was upgrading their car, getting a new car, and you're under the threshold, just making sure that you've got an employee-employer relationship with your company. Doesn't matter what that wage is, There just has to be that relationship. And I think that's where a few business owners will get unstuck, because the ATO has flagged that as one of their, we want to make sure there's an employee-employer relationship. Whereas I think some business owners have gone, great, I'm going to buy the EV, then it's 100% in a sense deductible. I'm not going to have fringe benefits, private ad backs, because there's no private ad back because it's 100% tax deductible. So we've just then gone in and kind of generated a wage to make sure that we've got that as well. Do we have any other questions at all? Maybe I've addressed some of them. Some of these things, what you'll probably learn from the all of these different aspects I've discussed today, a lot of them depend on your situation when it comes to allowances and living away from home, reimbursement. So feel free to reach out and we can work through kind of the kind of decision tree as to how that might relate on that side. So we've got two more on the employer series coming out. We've got the super guarantee, employee terminations. I've added a few more to this one as well. I'm going to talk about maternity leave as well on that one. Oh, there was two other aspects I'm going to talk about, forgot, but you'll get them that have come out from post questions that we've had from people. And then the last one, I'm going to talk about changes in the legal landscape as well. I've got an employment lawyer who's going to join me on that, given the whole casual, what does it all mean? The changes in terminations, what all of those different aspects, and just some of the, as soon as you've got more than 15 employees, a whole new world of rules that are in place. So thanks very much for joining us today. And I actually finished on time, which is great, right on the dot. If you've got any questions, I will work together and get, probably Erin's my expert on doing this, an employee, a Xero how-to on how to do the salary sacrifice into Xero. Once you've done it once, it's not too bad. You can set it all up and makes it really easy, but you can really provide a lot of benefit to your employees by doing that. So thanks very much, everyone, for joining. If you've got any questions, let us know, and we will send out the recording. Thank you.